$5 trillion. It's a number that's, well, it's almost impossible to get your head around.
It really is.
To give you some context, that's about the GDP of Japan. We are looking at one company, Nvidia, with the same economic weight as, what, the third or fourth largest economy on the planet?
Right.
And when you see a number like that, especially after the run-up we've seen, the rational part of your brain has to be just screaming, bubble!
Of course. It triggers that reflex, doesn't it? Any student of market history sees a chart go parabolic like that and just, waits for the crash.
It feels like the peak .com era on steroids.
It does.
Yeah.
But I think we need to put the chart aside for just a moment and look at the physical reality underneath it all. We're basing today's deep dive on a really fascinating analysis by Johan Steyn.
Okay.
And he aggregates data from Reuters, Bloomberg, The Verge, right up to this month, February 2026. And his core argument is that if you see this as just a stock story, you're missing the point entirely.
So what is it?
It's an infrastructure story. Steyn's take is that this isn't a speculative bubble. It's a global land grab.
That phrase, land grab, that really stood out to me. It implies scarcity. It implies this isn't just about buying new tech for the IT department.
Exactly. It's about securing a finite resource. But, they're not fighting over oil fields or shipping lanes.
They're fighting over compute.
They're fighting over compute. The whole thesis is that compute has gone from being a commodity, something you just buy when you need it, to a strategic asset. If you don't own the land, you effectively cease to be competitive.
So our mission for this deep dive is to figure out if that thesis actually holds up. We need to look past the stock price hype and understand what companies are really buying with all this money.
Right. The Vera Rubin platform, that massive $500 billion booking number.
And then we have to pivot to the risks, the very real cracks in the foundation that could bring this whole $5 trillion tower crashing down.
And those cracks they're significant. We're not just talking about stock prices. We're talking about physical limits, thermodynamics, power grids, geopolitics.
Right. So whether you're holding the stock, working in tech, or just wondering why your electricity bill is going up, this affects you. But let's start with the why. Why now? We've had AI for a while. Why this explosion in early 2026?
Well, to understand now, you have to go back to late 2022. When ChatGPT launched, that was the proof of concept phase.
Sure, everyone was excited, playing with the chatbots. It was a novelty.
A novelty, exactly. But in the last 3 years, we've shifted from proof of concept to production.
And that is a huge distinction. Proof of concept is a couple of engineers with a credit card. Production is enterprise grade.
It's massive scale. And the hard truth the industry has had to accept is that intelligence at scale requires machines at scale. You can't separate the software from the hardware. If you want a smarter model, you need a bigger cluster, period.
Which brings us to that number Reuters reported. Nvidia citing around $500 billion in bookings. I want to pause on that, because bookings can be a pretty fuzzy term. Is this just soft interest?
That is the $500 billion question, isn't it?
Yeah.
But no. In this context, these are firm commitments. This is the backlog.
Wow.
To put that number in perspective, $500 billion is more than the entire semiconductor industry's annual revenue just a few years ago. This tells us the demand isn't speculative, maybe money.
This is the big players putting cash on the table.
It's Amazon, Microsoft, Google, Meta, and increasingly entire countries reserving their place in line.
It almost turns Nvidia from a hardware company into a utility. If you're building a skyscraper, you don't just decide if you want electricity. You pay whatever they ask.
That is the perfect analogy. The market is valuing Nvidia as strategic infrastructure. Investors are betting this build-out phase, the construction of this AI grid, is going to last for years, not just a few quarters.
But this is where I get a little skeptical. We know that in hardware, margins eventually collapse, right? If you make a hammer for $1,000, someone's going to make one for $500. It's 2026. Why hasn't the competition caught up?
This is where Steyn's analysis on the operating standard comes in. The moat. Most people think the moat is the chip itself, the Blackwell or whatever.
But it's not.
It's not. The moat is the ecosystem. It's the software stack, CUDA, and the networking.
We hear about CUDA lock-in all the time, but is it really that strong? I mean, surely by now the switching costs should be lower.
You'd think so, but it's actually the opposite. As the clusters get bigger and bigger, the complexity moves from the single chip to the network.
Okay.
When you're trying to string together, say, 50 or 100,000 GPUs to train one model, the way they talk to each other becomes the bottleneck.
So if I'm a CTO, I can buy a cheaper chip from a competitor.
Right.
But if I can't guarantee my 100,000 unit cluster will actually run efficiently, I'm just burning millions of dollars an hour in wasted power and time.
Exactly that. The risk of the cheaper hardware failing at scale is just too high. You pay the Nvidia tax as a kind of insurance policy. Once you've built your whole data center around their networking and your software team is optimized for their libraries, ripping it all out, it's surgery.
And they're not giving anyone a chance to breathe either. Let's talk about CES 2026. The Verge had great coverage of the Vera Rubin platform launch.
Oh, the Vera Rubin platform is a beast. And, I mean, the name is fitting, naming it after the astronomer who confirmed dark matter. This thing is designed to illuminate all the dark data that companies have.
So what's the big shift here? Is it just faster?
It's a functional shift. The key from the launch specs is the memory architecture and the optical interconnects. They've basically integrated the memory so tightly with the compute that the bottleneck of moving data around is, well, it's almost gone.
And that's critical for inference, for actually running the models.
Right. It's about solving the cost per token problem. They're dropping the cost of intelligence, which then creates more demand. But strategically, what this really does is force a refresh cycle.
So if you just spent $1 billion on Blackwell chips last year,
and now Vera Rubin comes out offering, say, 4 times the inference performance per watt.
you suddenly look like you're running a legacy fleet. You're uncompetitive.
You have to upgrade. It's a relentless treadmill. Nvidia is telling the market, we will innovate so fast that by the time you clone our last chip, it's already obsolete.
Okay, so the bull case is clear. Endless demand, an unbreakable moat, and flawless execution. But our job is to find the cracks. And at a $5 trillion valuation, even a hairline fracture could shatter everything. Where does this go wrong?
The first crack is what I'd call the paradox of success. Nvidia's greatest strength is also its biggest vulnerability. I mean, just look at who's in that $500 billion order book.
It's the hyperscalers. Microsoft, Amazon, Google.
Exactly. These are companies with basically infinite resources, some of the best engineers on the planet, and they absolutely hate being dependent on a single supplier. It's an existential risk for them.
The classic frenemy dynamic.
Totally. They're writing checks to Nvidia with one hand and, green-lighting R&D budgets to kill Nvidia with the other.
And by 2026, those internal projects are getting pretty mature.
They are. We're not talking about simple chips anymore.
Yeah.
Google's TBUs are in their, 6th or 7th generation. Amazon's Trainium and Inferentia are being deployed widely for their own workloads. Microsoft is pushing its Maya Silicon.
But can they really compete on the high-end stuff, the frontier model training?
Maybe not for the absolute frontier, the GPT-6s of the world. But here's the trick. They don't have to. They just need to be good enough for the bulk of the workloads.
How?
If Amazon can move, say, 30–40% of their inference traffic, all the day-to-day chatbot stuff, the summaries, onto their own cheaper silicon, that bites directly into NVIDIA's share of wallet.
And if the market gets even a whiff of that $5 trillion valuation suddenly looks very different.
The multiple collapses. Which brings us to the second crack, execution risk. Bloomberg had a report back in January about how bullish NVIDIA's leadership was on the outlook. But when you're priced for perfection, you have to deliver perfection.
We saw this with the Blackwell rollout, right? Some minor delays caused a huge panic.
And with Vera Rubin, the complexity is an order of magnitude higher. If your manufacturing partner, TSMC, has any kind of stumble or there's a raw material shortage, the delivery timelines slip. And when you have customers who have prepaid billions, next quarter is not an acceptable answer.
So the supply chain is a tightrope. But let's talk about the crack that no amount of engineering can really fix. The physical world, the energy problem.
This is the hard wall. You can code your way out of a lot of problems. You can't code your way out of a lack of gigawatts. These new clusters, the Vera Rubin generation, they consume power on the scale of a city.
I've seen projections that data center power demand is going to double or triple in key areas. We're not talking about plugging into the wall. We're talking about needing new power plants.
Now here's the mismatch. It takes NVIDIA, 3 or 4 months to make a chip.
Right.
It takes 5 to 10 years to permit and build a new power plant or a high-voltage transmission line.
So there's a speed limit.
A hard speed limit. In places like Northern Virginia, Ireland, Singapore, they're effectively out of power. They're turning away business.
And it's not just the power generation, it's the boring stuff, isn't it?
It is the boring stuff. Supply chains for high-voltage transformers are backed up for years. So NVIDIA can ship the chips, but if the customer can't energize the rack, they stop buying. That physical wall is maybe the single biggest threat to this whole thesis.
That's a sobering thought. It connects the cloud right back to the dirt and the wires. Okay, I want to pivot to our final section here. Let's talk about the bigger picture. Steyn's analysis brings up this idea of national competitiveness.
This is where the story goes from business to geopolitics. Chips and AI infrastructure are now strategic national capabilities, just like having a navy.
And he specifically mentions the importer dilemma. Can you unpack that?
It's this idea that the world is splitting into two tiers. You have intelligence sovereign nations and intelligence-dependent nations.
Okay.
An intelligence sovereign nation, the U.S., China, maybe a consolidated EU, has the domestic compute to train its own foundation models on its own data, reflecting its own culture.
And the dependent nations are everyone else.
They're the importers.
Mm-hmm.
If you're a mid-sized country, South Africa, Brazil, Indonesia, and you can't afford the $10 or $20 billion entry fee for a sovereign cluster, you have to rent intelligence via an API from an American or Chinese company.
That sounds like a new form of colonialism, digital colonialism.
It is. Think about it. If your doctors, your lawyers, your students are all using AI tools and all of that intelligence is running on servers in Oregon or Shanghai, you're outsourcing your country's cognitive infrastructure.
You're paying a permanent rent on your ability to think.
Exactly. The value accrues to the owner of the infrastructure, not the user. Steyn argues this land grab isn't just about corporate profits. It's nations realizing that if they miss this window, they could be relegated to the second tier of the global economy for the next 50 years.
That really elevates the stakes here. It's not just about Nvidia's next earnings report.
It's about the structural balance of power for the rest of the century.
So as we wrap up, let's synthesize this. We have a $5 trillion valuation that looks like a bubble on a chart.
But looks like a rational pricing of a scarce resource when you look at the actual demand. It's a rational response to a demand shock.
But a fragile one.
A very fragile one. It rests on the assumption that the physical world can keep up and that the hyperscalers won't revolt.
The next chapter of this story won't be about who has the coolest chatbot. It'll be about who can secure the gigawatts and who can pay the bill.
And if you're watching this, the signal to watch isn't the hype. It's the CapEx guidance from the hyperscalers. It's the delivery times on high-voltage transformers. That's where the real story is.
I want to leave you with one final thought to mull over. We've talked about compute as land. In the real world, land is finite. When the best land is taken, prices skyrocket and people get priced out. If compute is the new land, and it's constrained by energy and physics, does intelligence become a luxury good?
That is the ultimate danger, isn't it? If the best medical AI, the best legal AI, is only accessible to those who can afford the high cost of compute, then the whole democratization of AI thing is a myth.
We could be building a world where the quality of your decisions is determined by the size of your bank account.
A digital caste system based on processing power.
It's a heavy thought.
It is, but one we need to consider. That wraps up this deep dive into the compute land grab. We hope this gave you a clearer picture of the machinery humming beneath the headlines.
Thanks for listening.
We'll catch you on the next one.